Welcome to today's webinar featuring Kristina Hooper, hosted by CFA Society Chicago's Distinguished Speaker Series Advisory Group. Information on upcoming events can be found on the Society's website at www.cfachicago.org. All mics for attendees will automatically be muted during the event. If you would like to ask a question, please use the Q&A feature. This event is being recorded. We will begin the event with remarks from Kristina Hooper. Jeremy Here, CFA, co-chair of the Distinguished Speakers Series Advisory Group, will then join us to moderate questions from attendees. Kristina Hooper is the Chief Global Market Strategist at Invesco. She has more than 24 years of investment industry experience. Prior to joining Invesco, Kristina was the U.S. investment strategist at Allianz Global Investors. Kristina has regularly been quoted in the Wall Street Journal, the New York Times, Financial Times, Reuters, and other financial news publications. She was featured on the cover of the January 2015 issue of Kiplinger's magazine and has appeared regularly on CNBC and Bloomberg TV. Please welcome Kristina Hooper.
Thanks so much for having me. It is an absolute pleasure to be with you, albeit virtually today. So what I thought I would do is really lay out not only where we are today, but what our expectations can be for the economy and then, of course, markets in the near term. And then we'll leave a lot of time for questions. Let me start just with an agenda so you have a sense of the different sections that I'll be going through. If you wouldn't mind advancing to the next slide. What you will see is we'll cover first the pace of the pandemic and, of course, the implications for the economy. Then we'll go through a variety of macro scenarios, what the variables are and what, of course, our base case is. And then finally, of course, spend some time on the market response and the implications. If you advance to the next slide, we can see that the entire goal of the shutdowns that we've experienced in countries around the world is to bend the curve, or to quote Boris Johnson, squash the sombrero. The idea is that we not only want to limit infections and deaths, but of course limit the amount of stress we place on hospitals and healthcare facilities. And as you can see, there has been success in driving down, in squashing that sombrero, so to speak. The curve has been bent very successfully, most successfully, I would argue, in some Asian countries. It's been a bit more difficult in some Western countries. A lot of that has to do with when the lockdowns began. But in fact, we have seen the curve being bent. Now, if we advance to the next slide, what we'll see is that rolling 7-day average. And I would just spend a moment on this because so much of where we go going forward is really dependent upon the results we see, and in particular, the reactions to the rollback of the lockdowns. Because one of the biggest risks we have right now, as economies are moving forward with reopening, is that we have some kind of resurgence in infection rates. And I will call out as really an example, something of a gold standard for how to react is South Korea. You saw that relatively small spike in infections. That was quelled quite quickly because of the very, very significant infrastructure when it comes to contact tracing. That's been very, very successful, as has Japan. Japan just announced that they've essentially reopened all of the country at this point. And a lot of that has to do with their success in really driving down and driving out COVID-19. As you can see, the U.S. is still at a high level. We're going to want to watch that closely, given that we're in the midst of the rollbacks of the lockdowns, but we're also in the midst, of course, of civil unrest. And so there's the potential for a significant increase in infection rates just based on what we've seen in the last few days in terms of protesters in the streets. We also, of course, have seen behavior in some parts of the country that would suggest we could see a rise in infections just in terms of socializing, parties. So this is, I think, a time where we want to be super focused on the results of the data when it comes to infection rates. Thus far, we haven't seen any kind of significant spike, but we don't have the contact tracing infrastructure in most states, certainly nowhere near where South Korea is, for example. On the next slide, of course, we understand that this is the goal, right? That we can lower and, of course, not necessarily eradicate, but take down infections. We have to recognize, though, that there's the potential of a resurgence that's quite significant in the fall. And that's one that is factored into our worst case scenario, as well as a bad case scenario, a more mild version of the second wave. So I'll talk about that in a moment. But if you turn to the next slide, this gives you a sense of daily new infections. And these major countries are all on the right track. I will hold out China and South Korea as being well ahead of other countries in terms of driving down infection rates. And I focus on that because that means we want to follow economic data there closely. That means that if we are able to follow, if we're able to get those infection rates down, even though we are reopening the economy, what we have to look forward to is some of the economic data that is currently being seen, in particular by China. We just got some good PMIs in the last couple of days that suggest not a dramatic recovery, but a slow and solid recovery for China. If you advance to the next slide, this gives a sense of the level of stringency. Now, this is something that is tracked. It's called the Blavatnik Index, and it's tracked by Oxford. And the idea is that essentially you want to have a high level of stringency when infection rates are high, but as soon as you take down those infection rates, we want to see stringency come down. Now, you can see that China has had a high level of stringency. That has, of course, come down. In the US, we're likely to see stringency come down as well. That's the thick royal blue line on the chart. And of course, the UK also has a pretty high level of stringency. They just started bringing students back to school on Monday. So we're likely to see the stringency level come down there. We have to recognize that stringency is how we control the pandemic, but it's also, of course, how we drive down economic activity and see the kind of dramatic negative results that has been part and parcel of the data that we've seen for so long, and in particular, what we're seeing right now in the United States. On the next slide, it's helpful again to focus on China as an early mover into the pandemic and out of the pandemic. We saw a very big drop in PMIs, but also a rebound. Now, keep in mind that China is going to also suffer from the global economy slowing down. So it's not just a story about China's domestic recovery, but this is a story right now about China feeling a negative impact from other economies being shut down. That's ditto for South Korea. Some of the bad economic data we've seen in South Korea is reflective of really shutdowns in other parts of the world. But I will say that China has seen some nice improvement. The return to work numbers have been have improved dramatically since early March. It's definitely on the road to recovery. Now, on the next slide, you'll see that PMIs have been something of a tale of two cities, but it is the opposite of what we saw during the trade wars. Recall in the trade wars, it was the manufacturing PMIs that were battered. This time around, it's the service PMIs that have been hurt. And of course, that reflects the nature of this economic crisis, one in which, because of the pandemic, we've had to shut down restaurants and all kinds, and hotels, and all those really service areas of the economy, which is why the service PMIs have been hit so hard. We've also seen this happen so rapidly that essentially we've seen a full recession's worth of private spending contraction in one quarter. In fact, we've seen really a full recession's worth of just economic carnage in really compacted into an extremely short period of time. And that is the reality of this crisis. That's what happens when essentially you flick a switch and you turn off an economy. Of course, turning it back on is going to go a lot more slowly than as we turned it back off. So we're going to want to assess data on a very, very regular basis. Turning to the next slide, we'll focus in on the US. The level of unemployment is very high. I know we're going to be getting the May jobs report this Friday. I wouldn't be surprised to see the unemployment rate at around 20%, given all the job losses. But I will say, and I wouldn't be surprised to see wage growth increase again, reflecting the loss of lower income jobs. But having said that, I do think that May will be our bottom, and that we will see relatively slow and somewhat uneven improvement from there. But this is very much just a dramatic hit to employment, and we have to recognize that that this could continue. It really is dependent upon the level of fiscal stimulus we see, and so I will cover that in a moment. And that's probably a very good segue to move into the next section. And so on the next slide, a lot of the questions we've been getting now is, what is the shape of this recovery? What do we expect, particularly in the United States? And of course, there are a variety of different letters of the alphabet being used to describe possible scenarios. And I would argue that the most likely scenario is, in fact, something akin to a square root shaped recovery. Or perhaps it's actually more accurate to use the term Nike swoosh. A recovery that starts off relatively slow, somewhat uneven, at times, can be somewhat stifled. But as therapies are developed, as a vaccine is developed, we're likely to see a pickup in economic growth. There are so many variables, of course, at work that it's important to lay out a variety of different scenarios. And that's what you find on the next slide. As you can see, the base case is that square root shape recovery. And that suggests a full recovery constrained by changes in private sector behavior to a certain extent, but a recovery nonetheless. And this is one that that doesn't anticipate any kind of significant second wave infection. There could be some, some low-level resurgence in infections, but that they would be quelled quite quickly. And our view on that is that once the US has learned how to deal with this, even just seeing how much medical staff have learned in the last 2 months, they're much better equipped to manage any kind of resurgence in infection rates. So we think this, this makes sense as a base case. But so much of this will be dictated also by what we see in terms of fiscal spending. So this anticipates stimulus commensurate with the level of the downturn. So in our worst case scenario, what we see is just a failure in truly containing COVID-19 in the US. For example, if we were to see infection rates increase significantly as a result of not just activity post the rolling back of lockdowns, but of course with protests now, that could again cause infections to rise. And this kind of start-stop nature to the economy in the US and a variety of states would be problematic, would create a pretty significant headwind for growth. And of course, in this worst case scenario, we would see a very significant secondary wave of infection that isn't well controlled. And so I will say I give a very low probability to that scenario. It's one in which you would have to have essentially everything go wrong at the same time. Whereas in the best case scenario, strong success in containing COVID-19 with a strong rebound, as well as high confidence by households and firms. That would be all the stars being aligned. Now, I actually assign a greater probability to that than I do to the worst case scenario. Some of it has to do with what we've heard in the last few days anecdotally from medical professionals, especially in Italy, that are talking about how what they're seeing now in terms of COVID-19, it's been pretty well eradicated in Italy, a Western nation that's going to be quite similar to the US in terms of behavior. And in addition, we haven't seen, while we certainly saw a hit to confidence, consumer confidence, we haven't seen, I don't think, as massive a drop in confidence for businesses or consumers as I would expect, given the nature of the crisis and the unknowns. A lot of this I attribute to the kind of dramatic monetary policy we've been given, which has really bolstered confidence, particularly for businesses. But this lays out a variety of different scenarios and the kind of shape of the recovery that we would see. But let me walk you through a few of of the possible implications. So I talked about that worst case scenario and seeing a second wave. That is the scenario in which we would see a W shape to the recovery, because the second wave would be very significant and we wouldn't be able to treat it quickly as I think would be the case. So this is a scenario where I think we'd see the greatest erosion in both consumer and, to a lesser extent, business confidence, but it would be quite dramatic. It would also require the greatest level of fiscal stimulus, of course, to attempt to maintain solvency for firms and for households. But again, I think this is a very, very low probability of happening. We do have that cautionary tale of 1918 and that second wave of the Spanish flu being much worse than the first. So I don't want to dismiss it entirely. I do believe it's a very low probability. But as I said, much of this is dependent upon the level of fiscal stimulus. And in the next slide, we lay out the room for maneuver, so to speak, in terms of what's likely to be the ability of countries to spend to provide fiscal stimulus. Now, Germany thus far has provided significant fiscal stimulus, as has the US. It's going to be more difficult for some emerging markets countries to provide adequate stimulus. It's not to say that they haven't, we've actually seen significant stimulus from some EM countries. But there's a question as to, especially in a worst case scenario, if they'd be able to provide ongoing, the necessary level of ongoing fiscal stimulus. But the next slide helps put fiscal stimulus in context. And what we tried to do is create an apples to apples chart. This is slide 16, which shows as a percentage of GDP for that country, the level of spending. And we also break out, if you wouldn't mind advancing to the next slide, slide 16. We also break out stimulus for developed economies in terms of direct versus tax deferrals versus loans, loan guarantees. And so as you can see, Germany has a very significant level of stimulus, as do a number of countries. The US has high level, and I think this is important to stress, a high level of direct stimulus, which I would argue is more valuable than the more indirect forms of stimulus. So while we've been eclipsed by some of the other countries, it is still high. And again, the direct stimulus is likely to be more effective. Now, of course, that's a gross generalization. A lot of it has to do with the actual spending programs, but I'm fairly optimistic, and especially I'm optimistic that we could see more fiscal stimulus in the US. In terms of EM countries, it was a little more difficult. We broke it out in terms of direct in the dark blue and indirect. So that includes tax deferrals, loan guarantees. It's sort of just sort of a big tent. And as you can see, China's stimulus, and I apologize, this was not updated to reflect China's announcement the other day, but China's direct stimulus has gone up. Korea has a very high level of stimulus. We need to see more, though, from a lot of these countries. In particular, Mexico is one where infection rates are rising, as is India. And of course, Brazil has a very high level of infection. While it seems high in terms of the percentage of GDP being spent, more is needed, I would argue. We also have a situation in emerging markets where some of the countries just don't have the healthcare infrastructure to manage this the way developed countries do. So it's not just about the fiscal stimulus, it's about the infrastructure. So we want to pay close attention to what's going on there. Now, just to focus in on the US for a moment, the next slide gives a nice summary of the CARES Act. That seems like ancient history, but it was only passed about a month ago. And it's quite significant in terms of the kind of funding that it provides. But having said that, I would argue that that is still not enough. And that one glaring area that needs funding is state and local governments. Now, it's significant enough that Jay Powell has talked about it in recent speeches in his recent presentation to Congress. He even shared the statistic that about 13% of jobs are provided by state and local governments. Now, a number of states have balanced budget requirements that mean that they will have to slash spending dramatically this year if they don't get some kind of stimulus provided by the federal government. So I'm optimistic that this is not the end. It can't be the end of fiscal stimulus, in my view, for the US. I think we'll need to see that injection, even though the economy is reopening. And even if we don't see any kind of resurgence in infections that causes any kind of new shutdowns, this is just necessary given the kind of hit that has already been taken by state and local governments. There is funding in the HEROES Act, which was passed by the House. Much of it is just a Democratic wish list, so I don't expect it to get passed by the Senate. But hopefully the Senate will will pass some elements of that, most importantly, that state and local government funding. So if you want to forward to slide 19, of course, I didn't spend a lot of time on the monetary policy response. If you just want to scroll over one more to the next slide. This gives a brief rundown of what we've received. I think suffice it to say that Jay Powell has been very clear that the Fed stands ready to do whatever it can do, whatever is necessary. He channeled his inner Mario Draghi in really trying to articulate this spring that the Fed is there for markets, and again, by any means necessary, would provide backstops, would provide monetary policy accommodation. I think that has been extremely powerful. I think that is the reason why we've seen this decoupling of the stock market from the economy that really started at the end of March. We also, of course, if you turn to slide 20, had this alphabet soup of facilities created by the Fed. Some just coming online now, but this is really quite impressive, and again speaks to the Fed being an activist Fed. I think we look back at the global financial crisis and think of the Fed as doing a really impressive job. This Fed, this Powell Fed, has outdone the Bernanke Fed. I'll skip over the next few slides. Feel free to peruse them at your leisure, but let's turn to slide 23 because I want to stress that other central banks have done a lot as well. And actually, if you just advance to slide 23, other policy responses are mounting. What we've seen, in particular from the Bank of England, has been pretty massive monetary policy support as well. Really, the major central banks have tried to follow the lead by the Fed. I don't think they have been as accommodative as the Fed. They haven't provided as many tools, but it is pretty impressive. And while it doesn't seem too well coordinated, what I think it has done is created an environment where there's greater confidence, not just in monetary stimulus, but in fiscal stimulus. What we've seen is more than we saw during the global financial crisis. Leaders, to a certain extent, are listening to the calls by central bankers that they need to be partners to central banks in terms of providing stimulus. So let's just spend a few minutes on the asset class implications, what we've seen in terms of, first of all, a stock market reaction on slide 25. What we've seen is, and I apologize, this is not updated through the end of the month. It's mid-May. So, but we've seen improvements since then. And what I think is moving markets the most, of course, is just this level of monetary policy accommodation. I think of the Bernanke put during the global financial crisis. This is the Powell put, and it's had an impact. China has in particular done very well, and I think that makes sense just given where China is and the way it's been able to adequately manage the pandemic. Now, there are some victims in the current pandemic. Capital markets certainly have benefited in general, but if you turn to the next slide, slide 26, you can see one area that has really gotten hit is dividends. We've just seen an enormous number of dividend cuts. What's interesting about the global financial crisis is that there was something of a lag before companies cut dividends. They were more reluctant to do it. And I think some of it has to do with the nature of that crisis. Again, this is a crisis that came at us at about 120 miles per hour as opposed to 60 miles per hour. And I think it caused companies to react more quickly. The reality is that this is a politically charged environment. So it's not just dividends. It's a much bigger issue is stock buybacks. And it's not just, of course, the politics or the optics of stock buybacks, but the fact that companies just don't want to be spending cash that way anymore. So this is viewed as almost a necessary evil, and given the nature of this crisis. But I would expect more dividend cuts. Every now and then, a company announces actually a dividend increase, which is a wonderful thing to behold. The reality is, this is an environment where dividend cuts are going to be coming fast and furious. If you turn to the next slide, what we've seen is a pretty significant reaction to this crisis. But for the most part, this is an environment where, as we know, stocks have done very well. They have, so to speak, a put under them. The 10-year has been telling us something different. And I view the 10-year quite often as being perhaps a more accurate gauge of fear. And I believe it's also, of course, a fairly good predictor of economic growth in the shorter term. And so we could see a lot of volatility in the 10-year. Things could change with developments. Again, fiscal policy becomes even more generous. If there's some healthcare advances and therapies or vaccine, I think we could see a pretty significant spike in the 10-year. But it's certainly telling us a different story than the stock market right now. Copper to gold ratio is of course telling us another story, and I would expect we're going to see periods where gold rallies, but at the end of the day, I think we'll see copper strength relative to gold, just given that economic recoveries are underway and countries like China are at the forefront of that. On the next slide, it's clear that the Eurozone is under pressure. And that's why I believe the European Union acted as they did in a very historic way. It's been dubbed the Hamiltonian moment for the European Union. And that's probably a fairly accurate description, just given how critical it is for the EU to not just be a monetary union, but to be a fiscal union. And so if this were to be passed, I think it could have a lot of important implications, not just for European assets, but also, quite frankly, for populist movements in Europe. I don't think they'll have the level of popularity that they have enjoyed just because the European Union is fixing what it's doing. On the next slide, you'll see that credit spreads have come down. I think that is very much a function of what the Fed has done. And I think, again, speaks volumes to the kind of confidence that the Fed has created. The last slide, slide 30, oh, sorry, not the second to last slide, slide 30, gives a sense of where yields stand relative to history. And I think that's a very important slide to look at. We're clearly in an environment of financial repression, which helps explain why risk assets are so popular. This is a story of relative attractiveness. Finally, just to talk a moment about implications. I mentioned the monetary policy having decoupled from the stock market. Having decoupled the stock market from the economy. Also, there is, everyone worries about, I shouldn't say everyone, there are those who are worried very much about the potential for inflation, given the kind of incredible accommodation that we've seen. And of course, there are implications for the presidential election. I think perhaps my greatest takeaway from from what's going on right now is that our odds of having more fiscal stimulus are going to increase quite significantly have increased quite significantly just because we're in the midst of presidential election year. But certainly, this is an environment where there are many, many unknowns. That's why more than 1 in 3 companies in the S&P 500 have decided to dispense with earnings guidance this year. That's why China has decided to dispense with a forecast on GDP growth this year. There are many, many unknowns, but I do believe that in an environment in which an election, an important election is coming in a couple of months, that increases the odds of fiscal stimulus. And I do believe with this level of monetary policy accommodation, we're likely to see a continued decoupling of the stock market from the economy. The greatest downside risk to the stock market this year, from my perspective, is not the pandemic. It's actually U.S.-China relations. Anyway, let me stop there because I know I've run over and take your questions.
All right, well, thanks, Kristina, for a great presentation. Very interesting stuff. You probably could have spoken for another hour easily on each of the subjects you covered, so thanks for keeping it somewhat brief. We have a few questions coming in, and I'd ask everybody, please use the Q&A panel at the bottom, submit questions. We want to keep Kristina busy and make her earn her paycheck today. So I'll start with a question from Bill. The Congressional Budget Office estimates that the U.S. economy would not catch up to the previous high prior to the COVID-19 until 2029. How do you explain that, given your base case for the recovery? So how do you reconcile those two views?
Well, I think the CBO has historically, I mean, let's face it, it is very hard for anyone to forecast the long term. The Fed really tries to dispense with forecasts of beyond really 18 to 24 months for that reason. So I will say that I think the CBO is certainly ambitious in laying out expectations like that, but so much will be dictated by what happens in the shorter term. If there's enough fiscal stimulus to maintain solvency for households and for firms, especially programs targeted to keep people in their jobs as opposed to paying their unemployment, that will have a significant impact on the kind of recovery we see. Again, my base case is not a V-shaped recovery, but it is a square root shaped recovery. And I would expect that would mean a recovery, and you know, depending upon the programs we see, if we see a big infrastructure spend, that could make a big difference. There's no reason, I think, again, it's very hard to predict 2029 when we have so many variables at play just over the next 3 months that could make a difference. But in particular, we're hearing more and more about infrastructure. And if we see enough money put into infrastructure, that could make the scenario more attractive. So I think it's, again, very hard to define where we're going to be in 10 years, but I do believe we'll see a recovery before then. That's certainly our base case. But if we don't get any more fiscal stimulus, if taxes rise in this environment, all kinds of things like that could happen, and that would take us to the CBO scenario.
Okay, great. Thanks. So next question. Have you done any analysis on jobs that might be eliminated permanently after COVID-19? In other words, what does our recovered economy look like compared to the pre-COVID economy? That's from Alex Gall.
I think that's a great question. And actually, we're spending some time being futurists, which is what you really need to be when you're thinking beyond the next 6 months, the next 12 months. It's what happens to commercial real estate, what happens to, you know, what jobs stay, what jobs go. And I think a lot of it really is dependent upon how long the economic recovery takes, and if there is a second wave of infection, and how quickly a vaccine is developed. I would argue that if we got news in September that a vaccine had been developed, that we probably wouldn't see much in the way of structural change to the economy, that people would go back to normal. You could even see that without the discovery of a vaccine in the near term. I look back to the Spanish flu in 1918. People still packed Yankee Stadium after that. there wasn't a lot in the way of a paradigm shift. But having said that, you know, we are contemplating what jobs could go away, and much of them are jobs that have been in danger because of technological innovation, but we would just see an acceleration of that trend in this environment. So, you know, some of the back office operations might accelerate. Companies might be more interested in reducing the number of employees. So outsourcing becomes a bigger, more attractive area to focus on. We're also, of course, seeing companies that are benefiting from this environment where travel budgets, expense budgets have been slashed, benefiting from that. And so I think one of the areas that will be very slow to recover is business travel, business hospitality. So that could have an impact on that industry for significant time, if not, you know, sort of a more permanent paradigm shift.
Okay, yeah, that's pretty good. That leads to a whole bunch of questions that I had prepared for this, but I'm going to go ahead with the questions that people have put in here. Let's see, could you please comment on the economic relationship between US and China going forward in light of recent tension? It's a great question.
So, you know, I talked about the US and China relationship being the single greatest downside risk to the stock market this year. I don't think it's as big a risk to the economy because I just don't expect there to be a rollback of phase one. Both sides need phase one, but the US in particular needs phase one. And what we saw last week, first of all, China certainly has taken advantage of the opportunities presented over the last month to flex its muscle, to for example, move ahead with the national security law vis-a-vis Hong Kong. All those things have been calculated because there is an expectation that the US won't push back in the midst of a pandemic in an election year. And I think that's largely been probably an appropriate calculation on China's part. And we saw just last week, I think the president's announcement, everyone feared that there'd be tariffs, rollback of phase one, and it was really quite benign. But China still felt the need to flex its muscle and say it was going to halt temporarily the purchase of some US agriculture products. So it's clear that we're at a disadvantage in terms of negotiating this year. So I don't expect there to be, there could be some inflammatory rhetoric, but probably less because China is flexing its muscle quite a bit. But this is a situation where because it's a campaign year, we're going to probably hear both candidates, but in particular President Trump, you know, criticize China. But at the same time, I think there's going to be very little in the way of actual actions taken vis-a-vis China. So certainly on a day-to-day basis, news flow could send stocks down, but I don't see anything very significant. And certainly I don't see any real impact on the economy.
Well, you brought up the election several times, so I'm going to interject here. Any calls for the election?
That's beyond my abilities. But what I will say is that an election year means we're likely to have more spending, and that's a good thing. I'm a conservative in terms of running deficits, except in times of crisis. And this, in fact, is a time where we can't be focused on debt, I don't believe. We need to be loosening purse strings because, and I think Jay Powell put it quite eloquently a few weeks ago in his testimony to Congress, we can either pay today or have a much bigger bill in the future because we've allowed households to become insolvent, companies to become insolvent. It's just a lot easier to recover when people are essentially, and businesses are being subsidized for a short period of time. So to me, that is the real positive of being in an election year. I think that the outcome hasn't been dictated yet, A lot of it will be dependent upon the developments over the next few months, how significant of an economic recovery we see, and of course, perceptions about the pandemic in the future, if in fact we get a second wave.
Okay, that actually brings me to a really interesting question. What is the long-term outlook for large urban areas? Chicago, New York, LA, San Francisco, Seattle. Will we see municipal defaults?
So I don't think we will see municipal defaults. I think that would be so problematic and counterproductive for economic growth that I don't see the government, no matter who's in charge, allowing that to happen. But having said that, I do think that we are going to see some changes in the next year or so in terms of people moving out of cities, businesses changing how they operate, and how many employees they stack into big office buildings in big cities. I just don't know if that's a permanent shift or a relatively temporary shift. Again, the 1918 Spanish flu would suggest that it is going to be a temporary shift, but it remains to be seen. If we do see a more permanent shift, that's going to put even more pressure on these cities that are struggling, that are under a pretty significant pension and healthcare burdens. So that calls into many more questions, but in the near term, I don't see this happening.
Okay, the next question. Could you please comment on potential for deflation in the medium term? Arguments made at other CFA events center on demographics and oversupply, coupled with reduced demand from COVID and recent economic shocks.
So, monetarists would say that this is all about the money supply and the velocity of money, right? And that will dictate whether or not we see inflation. Now, during global financial crisis, we saw money supply increase, but the velocity of money go down. And so we didn't see the inflation that so many people expected. And that was attributed to a hoarding of cash on the part of many businesses. So, as I look out today, I think this is a great debate to have. And I don't have, a very strong opinion. What I will say is I could see the hoarding of cash happening again. But I'm not 100% sure at this point. So much of it will be dictated by business confidence readings over the next few months, consumer confidence readings over the next few months. I think will help give us a better picture of that. Excuse me. I will say that if you're Janet Yellen, right, and you're looking, you're concerned about inflation, or you want to see about the potential for inflation, what you're going to look at is the labor market. In fact, she had created this 19 data points that she put into what she called the Labor Market Conditions Index, which has been dispensed with since she left the Fed. But it was really interesting because it helped her gauge what she thought was the potential for a rise in inflation. Her theory being that really so much of inflation is dictated by wage growth. We're living in a very unusual time right now where wage growth has gone up. It's probably going to go up more, but it really has no reflection on and will not have an impact on inflation because it has to do, of course, with so many people out of work. But we do have the potential for, and one of the candidates, Joe Biden, is advocating for essentially a doubling of the federal minimum wage. So this is an environment where we haven't seen, we're not going to see wages go up in the next couple of months. But if we have a different kind of administration in power, we could see some changes that could materially impact wage growth. But I don't know if it's going to be dramatic enough to drive up inflation significantly. So either approach suggests probably we will see very mild inflation, if any. But I'm also not in, sort of a heavy deflation camp either.
Fair enough. Okay, next question from Shri. What is your forecast for corporate tax rates? With the increase in government spending, do you think tax rates go up next year, especially if we get a Democratic president?
I'm going to say that I personally think it would be a mistake to raise taxes so quickly, just as it was a mistake to do sequestration as quickly as we did after the global financial crisis. We have to recognize that debt is going to go up. It's going to stay up. It's likely going to be increasing from here. The remedy needs to be down the road when the economic recovery is on a very strong, or at least very solid footing. So I understand that many are anticipating that a Biden presidency would lead to a rise in corporate taxes, but hopefully he will have economic advisors, and a lot of it will really depend on who he chooses for as Secretary of the Treasury, all those things. But let's hope that he has economic advisors that suggest that that might be a 2023 event or something like that, because it would be very problematic. I also think that because we're likely to see the U.S. Senate remain Republican, I think it's going to be very hard to flip the Senate in November. Even in a Biden presidency, it's going to be difficult to get any kind of rise in corporate taxes passed.
That's a good point, especially with the Senate. I agree with that. I mean, this question what should happen and the question what we think is going to happen, right? I think that's probably the simplest answer, is that even if Biden wants to pump up tax rates, he's not going to be able to do it. Next up, what is the end game for government debt as it's projected to reach 110% of GDP? We're going to have prolonged ultra low rates, massive long-term GDP growth, tax increases. Where do you see it going?
So we actually had higher debt to GDP levels when we emerged from World War II. And we grew out of some of that, right? We experienced some very significant growth. Demographics were on our side. That helped. But interestingly, what really drove down debt to GDP levels was the high inflation we saw starting in the late 60s and throughout the 1970s. And that's what really took debt to GDP down to, I think, at 33% at its low in the late 70s. So this is a scenario where I think, at least what we've seen thus far, in the last decade plus, is that there hasn't been a strong will to make very hard, make the hard choices in terms of cutting debt. You may recall the Simpson-Bowles panel that was sort of the bipartisan attempt to cut costs, to drive down debt. They talked about their frustrations and how hard it was to get anything in the way of cutting done. And so my expectation is that we'll probably see a scenario where rates remain low for an extremely long period of time, right? That's the path of least resistance. And that there's hopes that at some point the country inflates its way out of debt, but at least maintains, tries to tamp down servicing costs by keeping rates very low.
Right. Somebody mentioned in the chat about unfunded liabilities, Medicare, Medicaid, Social Security, the $200 trillion and counting. And if we keep rates really low, that makes those grow too, because you have a lower discount rate and so on. I'd be curious your thoughts on that.
Well, let me, as you can see, I don't give you concise answers, so my apologies.
Okay.
So let me try to make this concise and just say, it's hard for me to get my arms around how long Social Security has been able to go on without investing in equities. And I think that this is, desperate times call for desperate measures. States wouldn't run a pension fund like that. Why would Social Security be run that way? Think about all the sort of foregone returns over the years. That inability to keep up with demands is just a function of what Social Security dollars are invested in. So I'm hopeful that there's real structural reform that goes on. Again, I don't think there's any public will to cut benefits, but there has to be another way. And I think that other way might be changes to how how Social Security and other dollars are invested.
Fair enough. Can you elaborate on potential increases in productivity and innovations that may arise out of the COVID business environment?
That's a great topic. Part of that is going to be being a futurist, but I will say even in the near term, what companies have realized is that investments in technology are critical. And so I would expect, we were at the point before this crisis and for a few years before then, where we saw almost 50 cents of every dollar being spent on CapEx going to technology spend in some form or other. I think that increases, that we see more CapEx dollars go to technology. Now, of course, there's this fear that CapEx in general goes down given that environment, and that will vary from company to company. But we know that of those, of each dollar, a larger portion is going to go to technology. And I think that's how we enhance productivity. I would make the argument, and many people better than me have made a very cogent argument for why productivity has been disappointing as a result of that lack of CapEx spending. And I think in particular, it's that lack of CapEx spending on technology, and hopefully that will increase. I think a lot of companies already recognize that and are doing that. And so I think in the future, we will see a very significant pickup in productivity. I will also say keeping employees at home might also be a key to productivity. I don't know that everyone's personal experiences, but I can speak for myself and my colleagues. I think we feel as though we're working a lot more because we've cut out our commute, we've cut out all kinds of things. And so if there is that paradigm shift where we just see more in the way of working from home in general, that will also, I think, increase productivity.
Great. Besides the second wave of COVID-19, how do you feel that the protests that are going on will negatively affect markets and or the U.S. economic recovery?
So I was on Bloomberg Radio at 5 a.m. this morning, and I got asked that exact same question.
So you're ready.
I hearken back to 1968, which to me was the worst year in sort of modern American history of civil unrest. We had not only high-profile assassinations, but just really months of turmoil, months of chaos, months of rioting. And yet, if you look at stock market returns, they were positive. I think the S&P 500 was up about 7.7%. If you add in, if it's total return, it's like over 11%. And especially in an environment where the Fed has essentially decoupled the stock market from the economy, I just don't see any kind of significant impact. Yeah, maybe on a one-day basis, news flow might send stocks down, but I just don't see any kind of material impact.
Okay, this is the last question I have. With a fully implemented Brexit, will the pandemic stimulate further deconstruction of the EU and more nationalist populism in Europe?
That's a great question. First of all, I still am waiting for the UK to ask for an extension. I know they've been resistant thus far, but we'll see how this plays out. But whenever the UK leaves, I think there are a lot of question marks about the European Union and its viability. But I do believe that the EU made an important step towards progress with its financial burden sharing in its proposed stimulus package. Now, we of course have the frugal four countries in the EU that are skeptical. They don't want to be financial burden sharing. But if the EU can get this passed by all of the EU countries, I think that would be an important step forward and really, I think, knock the wind out of arguments that many populists have made and really unite the country. But of course, I think that this is going to be a difficult thing to accomplish. If it fails, I would expect there to be a very significant growth in populism and just more chasms in the EU.
Okay, well, if you'll indulge me, we did get another question in the chat. Do you see, do you see the the resiliency of the stock market, almost as a stock market bubble, and what's going to make it pop. You know.
So I don't know if I would call it a bubble. Certainly valuations are very, very stretched, but I think of it as a function of, you know, relative attractiveness of asset classes. So I don't expect a popping of it, but I would expect that at a certain point it plateaus or really goes into a phase where it's not very much in rally mode, but is more moving sideways as it waits for earnings to catch up, which could take some time. I think we should be prepared to expect more volatility on a day-to-day basis moving forward. And a lot of that, of course, in the short term will be driven by US-China news flow. But at the end of the day, valuations are not predictive in the short run. They are very predictive in the long run, but it takes time for that to actually take hold. And so I wouldn't expect any kind of significant bubble bursting. Now, that doesn't mean we can't see a drop of 5 to 10% this year, but I would expect something of a recovery and just chalk it up to the kind of volatility that is expected in this kind of unusual environment.
Okay, great. I think we're going to wrap up now. So thanks, Kristina Hooper, for speaking with us today. And thanks, everyone, for joining the webinar, and thanks for your questions. If you have any questions about today's event, please contact the CFA Society Chicago office at info@cfachicago.org. Okay, thanks, everybody, and thanks again, Kristina.
Thanks for having me.